Welcome to the Deep Dive.
Great to be here.
Today we're diving into Cosmo Energy Holdings. Now, this is a group that's clearly thinking, long term.
Sustainable growth, contributing to society. It's right there in their values.
Yeah, harmony and symbiosis, creating future values. We've got their integrated report for 2024 right here.
And their big plan, the 7th Consolidated Medium-Term Management Plan.
Quite a mouthful. Oil and new next stage. Catchy slogan, though.
It is. It signals that balancing act between their core business and, well, what's next?
Exactly. So our mission for this deep dive is really to unpack all that. Look at their businesses, the financials, and how they plan to create value going forward.
Sounds like a plan. It's a fascinating time for companies like Cosmo navigating this huge energy shift.
Okay, let's kick off with their bread and butter, the oil business. They're not just sitting on it, are they? They're pushing competitiveness with tech.
Right, the digital transformation, the DX initiatives, they started back in FY 2023.
Yeah, things like that, asset performance management system, the APM.
Using data to keep things running smoothly. And the digital twins. That's pretty advanced stuff.
So what's the goal here? They want to pull all this refinery data together, right? To actually predict equipment failures.
Exactly. Cut down on unplanned stoppages. That's huge for efficiency and reliability. Plus, using AI simulations to manage risk.
What really strikes you about this whole DX push in their refineries?
It's the proactive nature, I think. Moving from reacting to failures to actually anticipating them. That's a big step.
Makes sense. And it feeds into profitability, but also that stable energy supply piece.
Definitely. And it's not just a small pilot project. They have a long-term roadmap for integrating data using AI. It's a serious commitment.
And some of it sounds almost sci-fi. Four-legged walking robots for inspections at Yokkaichi.
Yeah, it does sound futuristic, but it's practical. Gets eyes or sensors where it's difficult or dangerous for people.
And those 360-degree panoramic photos for virtual plant access? That's smart for remote work and diagnostics.
It all ties into making operations safer and more efficient, especially as they eye that 2050 net zero target. Integrating DX into safety culture, as they put it.
Okay, so they're shoring up the oil side, but then there's this big push into what they call new fields.
Right, the energy that shapes the future linked to their Vision 2030.
And the main goal seems to be building a profitable green electricity supply chain.
That's a major strategic shift.
Yeah.
And one big piece of that is sustainable aviation fuel, or SAF.
Yeah, I saw that. They're starting production aiming for 300,000 kiloliters a year by 2030.
And the really interesting bit is the plan to supply locally made AF from used cooking oil starting as early as 2025.
Japan's first, apparently. That's quite something, using waste for fuel.
It ticks a lot of boxes. Lower carbon fuel for aviation, circular economy. It's a smart move.
So SIF is one pillar. What else is in these new fields? Renewables.
Absolutely. Big focus on wind power through Cosmo EcoPower. They're targeting 2,000 megawatts of renewable capacity by FY 2030.
And most of that, 1,500 million, is wind.
That's the plan. But they're not just generating it. They're looking at the whole chain.
Like supply-demand adjustment and energy storage. I saw a target for 500 millijoule of battery function by 2030.
Exactly. And selling it too. Cosmo Denki Green for homes, and a business version with RE100 compliance options.
Helping companies hit their 100% renewable goals. They're aiming for 4 billion kilowatt hours in green sales by 2030. That's ambitious.
It is. It shows they're building a whole ecosystem, generation, storage, supply. It's comprehensive.
Okay, SAF, renewables. What else? Hydrogen.
Yep, hydrogen is definitely on the map. They've teamed up pretty closely with Iwatani Corporation.
Right, those joint ventures, one for stations, one for engineering services.
Iwatani Cosmo Hydrogen Station and Cosmo Iwatani Hydrogen Engineering. They opened their first station in Hiwajima just recently, April 2024.
And they're already picked to run 2 more sites, for commercial vehicles specifically.
Seems like it. Targeting that sector makes sense for early hydrogen adoption. The Capital Alliance with Iwatani really solidifies that push.
And then, almost as a side note, they're thinking about getting into lithium development.
Yeah, consideration is the word they used, but it shows foresight. Lithium is critical for batteries, obviously. Securing resources could be key down the line.
Okay, so that covers the new fields. Let's quickly touch on their other segments. Petrochemicals.
Right, through Maruz and petrochemical. Stable supply is one goal, but the big growth area is specialty chemicals for semiconductors.
Ah, yes, the photoresist polymers. They have a leading market share globally.
Apparently so. And they expect demand to grow about 10% a year. That's a significant niche.
So they're investing heavily there. New facilities, expanding capacity.
Makes sense, doesn't it? Capitalizing on a strong position in a growing market, it diversifies them away from pure energy too.
Good point. And finally, oil exploration and production. The Abu Dhabi connection seems key here.
Absolutely. That long-standing relationship with ADNOC is crucial for crude supply.
But they're also using it for decarbonization efforts. Joint studies on CCS, CCUS in Abu Dhabi.
Yeah, leveraging that partnership to explore ways to tackle emissions upstream, aiming for net zero by 2050. It shows they're thinking about the whole life cycle.
Okay, quite a range of activities. Let's pivot to the financials. How's all this translating into numbers? The report suggests things have improved.
Definitely. Profitability initiatives from the previous plan seem to have paid off. Look at return on equity, ROE.
Right, it beat their 10% target in FY 2023, even with those refinery hiccups.
Which really highlights the underlying strength, doesn't it? The trend over the last few years is clearly upward, excluding inventory impacts.
So the actual profit figures. FY 2023 ordinary profit, again excluding inventory, was 162.2 billion.
Yeah, up 19.3 billion from the year before. The forecast for FY24 is slightly lower at 160 billion, but still very strong.
And profit attributable to owners, or 82.1 billion in FY23, also up year on year. Forecast for FY24 is 79 billion.
If you strip out inventory valuation again, that FY23 profit number was even higher at 82.4 billion. A big jump.
So overall, a pretty healthy profit picture in FY 2023, even if the outlook for 24 is a touch more conservative.
Exactly. It points to a robust core business performance.
Yeah.
Likely helped by those efficiency gains and maybe some favorable market conditions.
What about their balance sheet, financial health?
That's another area where they've shown significant improvement. They actually hit their debt-to-equity and net worth targets for the seventh plan in the very first year.
Ahead of schedule. That's impressive. So the net debt-to-equity ratio was down to 0.83 times by March 2024.
Yep, down from 1.10 times the year before. Big improvement.
And net worth, over 600 billion.
601.2 billion to be exact. That beat their FY 2025 target already, and they're forecasting it to grow further to 630 billion in FY 24. Net worth ratio sitting at 27.2%.
So what does all this strengthening mean practically?
It means less financial risk, more flexibility. A stronger capital base gives them firepower for those investments in the new fields we talked about.
And it probably helped them get those A ratings back in FY 2022.
For sure. And it allowed them to issue straight bonds last year for the first time in 13 years. That signals market confidence in their improved financial standing.
Okay, makes sense. How about cash flows?
Also looking strong in FY 2023, operating cash flow jumped significantly to nearly 178 billion.
And free cash flow.
A big leap there too, 145.1 billion. They ended the fiscal year with over 105 billion in cash.
Wow, so that strong cash generation gives them options, right?
Absolutely. Invest in growth, pay down debt, and return value to shareholders.
Ah, the shareholder value piece. Let's get into that. They have a three-pronged capital policy.
Right. Shareholder returns, financial health, and capital efficiency. And they stress doing all three, optimizing efficiency and health together.
So on returns, what's the headline commitment?
A cumulative total payout ratio of 60% or more over the 3 years of the 7th NTMP. That's dividends plus buybacks.
60% or more. That's a pretty clear signal to investors.
It is. It shows a commitment to sharing the profits and confidence in future cash generation.
And they seem to be backing it up. They hiked the dividend twice in FY 2023.
Yep. Ended up at 300 per share. And now they've set that 300 level as the minimum floor for the whole plan period, starting FY 2024.
So more predictability for dividend investors. What about buybacks?
They did a 23 billion buyback in FY 2023. That, combined with the dividend, pushed their total payout ratio over 60% just for that 1 year.
So they hit the target in year one. That's quite a statement.
Definitely sends a strong message about shareholder returns.
Now, they do mention their PE ratio could be higher, and they need to communicate the potential of the new fields better.
Yeah, they acknowledge that the market might not be fully pricing in the growth from renewables, SAF, hydrogen, etc.
And the PB ratio? It's over 1.0 times now, but they see that as just a starting point.
Right. They're aiming for sustained value creation, not just hitting a certain metric once. More engagement with investors is part of that plan to explain those new initiatives.
So for investors, the takeaway is strong current returns, but also a focus on communicating future growth to potentially boost valuation.
That seems to be the message, yes. Balancing today's returns with tomorrow's potential.
Okay, looking ahead then. Assessing the business moving forward. This seventh MTMP is about leveraging that improved profitability for more value creation.
And they're pinning a lot of that on three key transformations: HRX, DX, and GX.
Human, digital, and green transformations. How vital are these?
I'd say they're absolutely critical. You need the right people, HRX, the right tech and processes, DX, and a clear sustainability path, GX, to thrive in the modern energy world.
So HRX is about motivating and upskilling employees, investing more per person, hitting engagement targets.
Yep, building the human capital they need.
DX we've touched on, but it's broader than just refineries, right? Transforming the business model, building data infrastructure, aiming for 900 core digital personnel.
Exactly, embedding digital capabilities across the organization.
And GX green transformation. Net zero by 2050 remains the goal.
Unwavering, they say, with that interim 30% GHG reduction target by 2030.
And they're putting serious money behind it. $400 billion planned investment between 2023 and 2030 in those new businesses like wind and SF.
That level of investment shows it's not just talk, it's a core part of their strategy.
They also mentioned strengthening corporate governance, board transparency, diversity.
Which is important for oversight and ensuring these ambitious plans stay on track and align with shareholder interests.
And they acknowledge the need to keep updating their net zero roadmap as things change.
Which is realistic. Technology evolves, regulations change. You need to stay flexible.
So overall, what's your assessment? How are they positioned?
Look, they seem to have a solid, well-thought-out strategy. They're leveraging their traditional strengths to fund the transition, which makes sense. They're improving financials, returning cash to shareholders, and investing in future growth areas.
But the execution is key, right? Especially in those new fields.
Absolutely. Making SAF, large-scale wind, hydrogen, maybe even lithium. These are complex, capital-intensive businesses. Delivering on those plans successfully is the major challenge and opportunity. But overall, they seem to be taking a proactive, balanced approach.
Okay, so wrapping up our deep dive today, Cosmo Energy Group is navigating this transition by trying to optimize its traditional oil business through innovation.
While also making a pretty aggressive push into new, sustainable energy sectors like SF, wind, and hydrogen.
Financially, they've shown improvement, strengthened their balance sheet, and are clearly committed to shareholder returns.
And underpinning it all are these big transformation efforts in people, digital tech, and green initiatives.
It's a complex balancing act for any established energy company these days.
Definitely. Sustaining the present while building a very different future.
Which brings us to our final thought for you, the listener. Think about this dual challenge. How do established players like Cosmo maintain today's profits while pouring billions into future energy systems where the payoffs might be years away and carry significant risk? How well do you think Cosmo's multifaceted strategy, oil efficiency, SF, wind, hydrogen, petrochemicals, positions them in this evolving energy landscape? What hurdles and opportunities stand out most as they juggle present strength and future ambition?
Lots to consider there.
Indeed. Thanks for joining us for this deep dive.